Good morning, traders. Today is July 3rd, the start of the summer months and the beginning of Q2 2022 earnings. Earnings will start to pour in here over the next 3 to 5 weeks, and we need to be cautiously aware of the fact that the markets are getting closer to a bottom, trying to understand what's going to happen over the next 6 to 12 plus months related to the Fed, the economy, consumers, pricing, and we're in for a bit of a gyration here in terms of the markets. I'm writing to say that we are not changing anything in our allocation levels. We are looking for bonds to kind of form support, maybe start to move higher. Dollar is still strong. Metals, I'll show you, are forming a very solid bottom, even though we saw some deeper downward moves. I'll show you on the custom indexes how metals are looking very promising right now. And overall, the summary of today's report is that markets are very close to a bottom, although not there yet. My custom indexes are showing that the markets are attempting to find support. I expect one final push downward, kind of an exhaustion move before a bottom actually sets up. And we may see a bit of a rally going into the end of the year. I'm expecting maybe a 15 to 20, 25% rally from current levels. Nothing really stupendous, but we could see a bit of a move, especially if the Fed pauses or reallocates interest rates based on inflation expectations. So currently, nothing has changed. We're not doing anything to change our allocation levels. We're still properly hedged. Metals, I'll show you in a bit, are looking to become very active over the next 12 to 24 plus months. And stocks, like I said, we have our 10% stock allocation. This means you can still be trading. You're just trading a very small amount of your capital into stocks. 55% is cash, 10% into bonds, looking to hold into a bottom here with bonds. See what happens with bonds going forward. We may start to allocate a bit more into bonds as things move. Our safe haven right now has been primarily in cash and metals, which are holding up quite well. The overall trend, oops, this is the old one. Here we go. The overall trends have not changed. The NASDAQ is still bearish, both short and long term. S&P is short-term bearish, long-term bullish. YM, short-term bearish, long-term bullish. In fact, all of them, except for oil, is short-term bearish, long-term bullish. Oil is long-term bullish, short-term bullish. And you can see here that we haven't really changed any direction with regards to the rotational modeling system. I got everyone out of the markets fairly early in 2021, near July and August. And the purpose behind that is I knew we were getting close to a top. How I could tell is very, very simple. I'll show you in my custom index charts why that's so important for you to follow my research and be aware of what's going on. But now we're getting into an early bottom stage. I'm not telling you to buy anything or take any aggressive moves right now. The time will come over the next couple of weeks where we will start to make a move. But right now we're getting into an early bottom stage. If we come take a look at the custom US to global index chart, you'll see here this COVID high gap support, which is the range of the US markets from this high to this recent low, is currently still holding. I expect that we could fill this gap, attempt to fill this move down here into this area, and then find a nice bottom out of this, moving back up into these ranges over here. This would qualify as a stage 4 of an exhaustion phase peak setup. We would see a rally from a deeper low here, a kind of a complacent rally back up into these areas, and then weaning and waning, and then eventually a deeper downside move. So that's kind of what I'm expecting at this point to play out over the next 12 to 24 months. The end of this year and going into early next year, 2023, may see a solid little rally out of this, may see us move back up into these February, March price levels, possibly a little bit higher before we roll over. European markets and global markets are already below the COVID highs back over here. They're down into this midpoint range, which I think we'll see again a bit of a bounce, maybe a 15-20% bounce over throughout the end of the year as everybody attempts to readjust before the global central banks and the Fed try to really battle ongoing inflationary concerns. We have a bit of a divergence here in RSI. with the U.S. markets. Could be close to a bounce, but I still expect a bit of a downside move on earnings expectations, and that's why I'm warning everyone, don't try to buy in right now. We could see another 10 or 15% to the downside, maybe a bit more down here if these lows get threatened on earnings changes and expectations. We could see it fall down into this area, below these COVID highs, possibly down into these 2019 upper price ranges, or these areas here, which is around the election, 2020 election range. We could fall down into this area, which is from 65 to 40, about let's call it a 18 to 20% further downside before we find a bottom. Next, we have the custom global assets. This is a weekly chart. You can see that global assets are deteriorating again. We're in a depreciationary cycle phase. You can see we've already moved down with RSI. Global assets really need to unwind a bit further. I'm looking at this area right over here, which is the early 2020 COVID area. So this puts us down in this 145 level. We need to see approximately another 10 or 15% downside move before we're going to get down into this area. This would unwind the COVID bottom and early rally phase that took place. And that's why I think it's important to see us unwind all of that. Many stocks are already below this level, but globally, we still don't have that unwinding of asset valuations. Next, we have the gold depreciation cycle phase. This is an older chart from May 21. Still showing really good opportunity here, even though gold is right now like 1813. So we're down a little bit from where we're at right now. But this support level, these ultimate lows back over here, are very, very important. 1725 is really critical support for gold. As long as we stay above that level, we're looking at some really good opportunity to the upside. And when I say really good opportunity, it's going to be a move like this or like this, which was a 750% move. This time, I think we're going to be looking at least 500% from current levels, which would put us up at around 10,000. Now, that is long term. So $10,000 for gold or higher, that is very long term. That's 5, 6, 7 years out. But this is a really unreal setup for metals. We've got hundreds of trillions of dollars of debt and liability running around the global financial markets. And depending on how this unwinds and whether it's orderly or unorderly, we could see a massive rally phase in gold. Could be even a 200 or 300% rally, which easily was done back here and back over here in the first phase. That would put gold from these levels up to about $4,000, $5,000 an ounce, which is, again, about a 150% increase from where we're at right now. Okay, next we have the gold to cycle index. This is something that I love to watch. It's performing very, very well. It's hooked up recently. Even though gold has gone down, this is hooked upward, indicating that we're now starting to see an appreciation cycle phase in gold. We're starting to see real accumulation. And I expect it to continue. We still need to get above these highs back over here to see some real accumulation in gold, but that may come over the next 20 to 60 days. It's showing very strong volume here, more volume at a bottom level than we've seen pretty much ever, except for back over here in 2010 and 11, which was the last major phase. Remember, gold peaked out over here in late 2011 and then started selling. Still a lot of accumulation took place at that phase before it finally weaned out. And then, of course, this was the bottom that took place in 2015-16 and rallied up a bit. This was a rally phase in 2019-20, which brought us up to 2,000, again, above new all-time highs. This time, I think it could go even further. It could go well above this level here, possibly up in 150, 140, maybe even a lot higher, 200 plus, which would be a huge move in gold. But we're very early in a bottom in metals, which is very, very exciting for us right now. The current real estate conditions, updated just last week, show that sellers are flooding into the market. House inventory is doubling probably every 30 to 60 days from where it was on inventory. You can see active listing count is the orange line, and you can see back down here it was minus 0.55 roughly. Now we're at a plus 0.3 roughly. And so we've had a huge change in the last 6 months in the amount of inventory that's piled into the market. Home reduction or price reductions are skyrocketing. They're now well over the 100% level and actually pulled back a little bit. Home prices, the blue line here has started to drop a little bit. You see here we have price reduction share is starting to, it's in the positive side, starting to drop a little bit, and days on market is about to turn positive. Understand that it was down here at negative 0.52 roughly, and now is at roughly 0.13 roughly. So understand we've seen a huge change in the market. Summarize, sellers are trying to dump assets and real estate at the highest price that they can get right now. Inventory is flooding into the market. I expect it to continue. I expect foreclosures and price reductions to continue. I expect prices to overall come down. This is going to be a flood of everyone trying to get out as fast as they can while prices are still relatively high. And I think buyers are very aware of the fact that sellers are moving into this mode, and buyers are basically going to be waiting for the bottom. Unless you're in a tough situation where you have to buy, I think you're going to be waiting for the bottom, because I think we're looking at a 30 to 40% decrease in housing prices over the next year or so. And simply put, the unwinding of asset values is going to continue. This is something you need to be aware of. The unwinding is going to continue unless the Fed tries to do something crazy, like move back to 0.25% interest rates and fall back into a very easy money policy. And even then, I think that the asset bubble that's been created, I think the bursting of that bubble has already got enough momentum right now that consumers will not chase a super easy Fed. We might get a little blip if the Fed does that in activity, but overall, I do not think this bubble has any real length to the upside until we get to some real valuation level that is acceptable. And I don't think we're there yet, particularly in real estate. We've got the highest, most expensive real estate market globally that we've ever seen, and the highest inflation rates, which are not going away right away. So this is going to unwind for quite a while. Next, we have the Consumer Engagement Index. This is a monthly chart where you can see we've stalled. This was May, this was June, this last little bar, and then this is early July. We are essentially stalling in this area after a deep, deep low in May. We could see support at this level. Remember, this goes back to 2012-13 levels here. We could see support at this levels. But I think that consumers are pretty much in shock, waiting to see what's going to happen. And my interpretation is that we could see a bit of a further downside move, possibly down into this 1.4 or 1.12 level, which would be where I'm pointing this low here, is very indicative. I think we could see it wean down to these levels here, which would put us back into 2010 and 11, near the bottom of the market after the global financial crisis. And this is really telling you that consumers are moving away from making big ticket purchases. I will tell you, out here in California, summer is rolling. People are still spending, boats are out, the harbors are busy, the lakes are busy. People are still spending. A lot of people are still taking their excess capital and still going and spending. So we're in a very early contractionary phase for the economy, for the consumer, which is why this could go down even further. Understand that consumers have, the marginal, let's say, consumers are already feeling it. The richer consumers, the ones that have wealth and assets stashed away, are still spending like mad. And they're still out boating and partying and driving their RVs all over the place and not really too worried about things. As the inflationary pressure continues to wean on the economy and sends the global economy a bit sideways, you're going to see an attrition of consumers moving more and more into safety. And that's what we got to watch for right now. We're kind of in that shock and awe phase where this is the initial blip downward for consumers, and now we need to see what happens next, which in my opinion is going to be a continued downward unwinding of consumer activity as savings and earnings and jobs continue to tighten. Next, we have the technology ratio index. This is showing you basically that the technology, I should have changed the colors here. So black bars are really white, white bars are really black. You can see that it's unwound back down here to the 2014-15 level. It is finding support, which is why technology could be a nice little bottom here. We could see it rally back up into these areas off a little complacency rally or dead cat bounce move here. This could be a good little move for 10 or 15%, maybe even 20% in technology stocks, depending on how earnings are coming out. And to be honest with you, I would watch the live trades setups for technology triggers that are going over there, or the TT scanner setups. We really need to see this support level here hold. Otherwise, we could be going back down into these 2011 levels, which is again another 10 or 15% downside, which could happen. So we need to really wait for a confirmation of a bottom here. But we're getting pretty good support right now. Moderate volume, pretty good support down in this area. We need to see how it plays out going forward. Next, we have this is an older, May 21st. That's an older one. I've already shown it to you. The Global Market Index. This is the Global Smart Cash Index. And you can see, this is April 9th. This is an old one. Hold on. We must have missed something here. Let me come back over here, figure out where I am. Okay, we will go to this, which is the FANGs Index. This will get us where we need to go. These are updated yesterday. So the FANGs Index, you can see, had a fairly strong rally down here off of support. We're back in the 0.50 Fibonacci retracement level. This is acting as moderate support right now. I will tell you that I still believe we need to come back down into this lower level, the 618 level. This is why I'm expecting a further washout low to occur back down into these levels. I think it's essential. I'll be honest with you. If we find support here at 50, which is a 50% retracement level, is a very solid level, we may see a bit of a bounce. This could be the bounce that we experienced already, but I think we really need to see this wash out down into this green area, reset into this 618 and this standard deviation channel here before we get any kind of a rebound back up into these areas for the FANGs Index and technology. So be aware. Buying in at this high right now or this moderate level here may be a bit risky because you could have a 15 or 20% further downside move. And I would expect that waiting through earnings and seeing what ends up happening with regards to forward guidance and the volatility that's coming over the next 3 weeks would put us back down here near these lower levels, which will give us a much better entry price. So being patient right now could really pay off for you and avoid a 15 or 20% downside risk. The U.S. stock market index, a lot of lines on this chart. Let me just highlight this light blue line, the cyan line with this level here. This indicates that we're already below the standard deviation channel, trying to find support. We've got this COVID high back over here, this other light blue level, and this is really where I think we're ultimately going to try to come down into these areas. Many months ago, I highlighted this downside area as an ultimate downside target. This still is in play. This could very well happen depending on what the Fed does, what earnings do, and how the markets react to earnings coming out, which would put us well below the standard deviation channel. This would put us in a very deep selling cycle, and this would be an excellent area to look for a bottom. But in reality, ladies and gentlemen, down in this area, right here, this yellow line where I'm circling, this is an excellent area to start looking for a bottom to set up. This would be a very deep bottom setup. Overall, ladies and gentlemen, I don't think that we're done with this trend. I think we are in the early stages of trying to bottom, and I think earnings are going to push us a bit lower as inflation, raw material cost, fuel cost, and labor, consumer demand are weakening. You're going to see layoffs, you're going to see updated earnings, you're going to see forward guidance move lower, and I think that's going to cause the markets to move quite a bit lower, another 8, 12, 15% downward as that shock reverberates through the market and tries to find some sort of a bottom valuation level. I still like this yellow level and this below this blue line here and this yellow level as critical support, right around 900, maybe around 850, which would put the S&P, give you an example, at 33, 34, below 3,400. I'll show you this in a minute, but below 3,400 on the S&P is really where I'm looking to try to find a bottom. Somewhere between 3,100 and 3,400, I think the bottom is going to occur. Okay, this is the updated Smart Cash Index. This is the global market index. You can see we've got a downtrend line here. We've got resistance here. We're making new lower lows as we go lower. We've already breached this level. And now, ladies and gentlemen, we're kind of setting up sideways, trying to find support right in this middle level here of COVID. I really think we need to wash out down in this 135, 134 level right over here, possibly a bit lower, and that will establish another bottom sometime in over the next 4 to 6 months. So we're really looking at a broad washout pattern, another 10 to 20% lower here, really before we find a bottom. Gold. Okay, now custom metals index. What can I say? Gold and silver are holding up. There's been a lot of talk about the move lately, and I'll show you this on a gold and silver chart, but I want you to see this chart, and I want you to see the real setup here. Even though gold and silver are moving lower, they're printing white bars or empty candles. So the scenario here is that we're getting real strength here, and we're seeing this outside of the channel. I feel it's going to rebound back up into the midpoint of this channel on fear, especially through earnings. Again, earnings coming in, with unexpected numbers and downward revisions. I think it's going to set a motion of fear in place, and I think metals are really going to shine, particularly gold and silver and platinum. Right now, I would tell you that this is a deep kind of extension, kind of like right over here in 2019, where we got out of the channel, we found some support, and then we started to really rocket higher. So I'm expecting another move here over the next 5 to 6 months back up into these highs, which I think will put us up near all-time highs again, above 2,000, possibly 2,100 or higher. And the reality is this is an excellent bottom setup. It's a really solid double bottom. We don't have any confirmation of trend change yet on RSI. So understand that this is a weekly chart. We do not have any breakdown below the 40% level here. This is really an exhaustion low. And we need to see what happens over the next couple of weeks. We could get into a new downward trend, though, if things really break ugly. But still, metals are holding up very, very well. I mean, you look at this from the 2018 lows all the way up here to the highs, with gold, with the dollar moving higher and with fear starting to permeate the market. Metals are really holding up down here near these lows quite well. And this is an excellent, in my opinion, buying opportunity if you have a long-term view. Valuations Index has moved down just like I expected. If you remember, we started covering this right after COVID, and we rallied through this high. I highlighted the apex and another apex. We've had a couple dozen apexes. I could draw another apex right over here before we get this breakdown. But the reality is we're now down in the upper range of valuations. We haven't gotten down into this lower range much yet. We are in a bearish trend. We are moving lower. That's why I believe valuations will continue to migrate lower, possibly down here into this 62, 61, possibly 55 level. Really find some sort of a lower valuation support level before we begin to move higher. And where we see it move higher, ladies and gentlemen, it'll more than likely just move back up to this blue line, which will represent a 10, 15, maybe 18% rally before it stalls out again, and we really transition into a post-COVID bubble market, which is what's happening. We are transitioning away from this excess phase. which, as you can see, the market stayed within this range, 2018-19, which was very strong market activity, by the way. Then we got into this excess bubble phase. Everything shot up from 40 to 50 up to 400. Understand that's an 800% move in this, actually 1,000% move from the lows, from these up into this excess phase, and then we're unwinding all of that. So valuations look like they've unwound quite a bit, but we still could have another 20 or 30% downside to go. So be aware, we're not quite at the bottom yet, but we're getting closer. The commodity gold index shows us that commodity prices are actually depreciating, and this is something I want you to be aware of. We are down near these lows. As consumers pull away from the economy, we're going to see it move even lower. We are in a bearish trend. We have no bullish activity. The economy, the global economy, is not strengthening right now. It continues to weaken. So as we continue to weaken, we're not seeing any real economic growth. We're seeing the global economy to weaken. So this will likely to continue to move downward. And we're looking again down here at this, let's call it 1.0, 0.8, 0.7 area. Really, I think that's where the target is going to be, possibly 0.5. You can see that we got down here to 0.4 right at the COVID lows. We're not quite there yet, but remember, this was an expansion economy. We had COVID hit, which shut down everything, shocked the market, moved lower, still had very easy interest rates. Remember, the Fed was very moderate interest rates here, then went to zero. Now we're back up to, 1.5% interest rates, and the market is still holding up around 2. I think we should be down here somewhere around the 0.7, 0.8, maybe even lower eventually if the Fed stays where they're at on interest rates. The volatility index is one of the reasons why I think we're setting up for a bottom, an early stage bottom right now. The volatility index has failed to move below this 6 level, which I would indicate as bearish. We've seen moderate bearish trending here through this consolidation. This is really almost a broad flag setup that we have going on right here. You can see that the volatility index breaks downward very aggressively in strong bearish trending. And then because we've been holding up near this 6 level, we haven't moved into extreme downward trending. That's why I think we're getting closer and closer to a bottom. We could still see it bounce around for a few more weeks around this 6 level, 8 level, meaning selling pressure is not over yet. But eventually I think we're going to get some sort of a relief rally, move it back up here around 11 or 12. That's what I'm telling you may come after earnings. We may get a 10, 15, 20% relief rally. And I think that's in the works. I think it's maybe a week or 2 or 3 away. We don't have any indication of it right now other than early signs that a bottom is forming. But after that, we could get a big breakdown to the downside. It could come, in my opinion, in 2 forms. Either January, February, March, April, depending on what retail does and how Christmas is, how the economy is doing, consumers. So near the end of this year, early next year, we could see a big breakdown in the markets. Particularly if inflation is still rampant and the Fed is having to raise interest rates even higher, or it could come as some sudden surprise in the form of some sort of credit collapse or banking collapse or foreign market collapse or currency collapse. We could see something like that really, and this is the difference between what's called an orderly unwinding and a disorderly unwinding. If we get an orderly unwinding where everything just plods along and a couple of bankruptcies here and there and the markets transition very slowly, then it'll be something where we may not see a breakdown in the markets until February through May of next year. If we get some sort of a surprise, a shock to the markets, then this could break down very aggressively, which is why we're not becoming super aggressive buyers in the market right now. We're actually waiting, protecting, saving capital, and trying to wait for the markets to tell us when the opportunity is there. Okay, and then now we're looking at my wave 5 complete, which is actually, if you follow my long-term signals, is actually wave 4. Let me show you that real quick. Right here, wave 4. Where is is it? Drawing a blank here. Hold tight, I'll find it. There it is. Okay, so now I'll drag this over here, and what we're looking at, many years, that last chart I showed you, let me show it to you real quick so you can see. This was created on May 2021. So this was a year ago, over a year ago. And I had done this analysis, and I had indicated that we are looking at a wave 5 rally. Well, as this continued to move higher up into this area, this became, instead of wave 5, this became an A, B, C to wave 1, and then correction to wave 2, and then rally to wave 3. This became wave 4. So we have wave 1 rallies up to here roughly. Wave 2 comes down to here. Then we have this move here, A, B, C, way up here to create wave 3, and now we're in a wave 4 correction. And this is what I'm showing you right here, the same setup. Here's our bottom, here's wave 1, here's wave 2, here's wave 3. You can see that's post-COVID. COVID's right here, all the way up to this rally here in the NASDAQ, and then we come back down here to wave 4, and eventually we're going to try to find some support down here in wave 4 before we potentially rally up to wave 5. This is where the next real big wave of opportunity is going to come. If my analysis is correct, there's two likely things that are going to happen. Number one, we're going to get this wave 4 ending somewhere down here and begin a wave 5 rally, which will be the Fed trying to keep everything moving, an orderly unwinding. We continue to move higher. Or what we have is some sort of a chaos event that unwinds, global chaos like the global financial crisis, and this will end up being an ABC rally to here. So we'll call that, 1, 2, 3, and there will not be any wave 5. We will see an ABC major wave down here to possibly somewhere above this level here, which would put us in the 5,500 roughly area for the NASDAQ. Compared to where we are right now, that would be another 60% downside move in the NASDAQ. So understand that this is really playing, it's going to depend on how things play out. Right now, I see it as a wave 5 is highly probable given what the Fed is likely to do, which is to, in my opinion, next year, lower or mitigate high interest rates, trying to get the economy kicking again. If there's some sort of an unorderly unwinding of assets, then we could see a very big drop from this point back down to these 2017-18 area lows, which is 6,500, 7,500. Be a big unwinding. That would be a 40 to 50% decrease in the markets. Okay, so now let me make sure I've covered everything. Covered that. Okay, TT Scanner. TT Scanner weekly updated data. We still have long energy. This has not changed. We're 20-some weeks in. We've hit all of our targets. Moderately close to our stop levels here, but we're still strongly positive. Oil's holding up very good right now. I'd like to see it break downward. I think it will, but we will see how this plays out over the long term. We have a number of short triggers that are active. We have 2 new triggers here in aerospace and defense is a new short trigger. We have a new short trigger down here in GDXJ miners. Remember, this is weekly, so this is reacting to the downside trend. You can see here we have moderate thrusting here, and we have active early stage downward thrusting here. This looks like a very good trigger. I like this trigger a lot. I would be very cautious of this trigger. I think metals and miners are probably going to bounce here pretty soon. We have a number of triggers that are still active. We have right here, the Dow Jones Internet is already up 19%. It's been in the trade 9 weeks. We have the Jets, global Jets Etf, been in the trade 2 weeks. It's already up almost 5%. We've been in this trade in communication sector, XLC, for 9 weeks. It's already up 10.42%. We have this trade here, which is tech sector, has been in the trade for 8 weeks, already up 11%. And we have this trade here, semiconductors, SOXX, Then in the trade 1 week, and it's up 6.07%. These new flat triggers are trades that were taken last week early and got flat. They are now exited out of the trade. They didn't move in the direction we wanted. So these are trades that are essentially completely flat. We're not looking to trade them. If you took any of these trades, you want to get out of them. You can see here we have this aerospace ITA defense sector here that got flat while we have this new trigger here. So quite possibly this could be a mixed trigger here for this XAR aerospace and defense fund. But overall, we're doing okay. If you follow the TT scanner triggers, the idea behind this is you're only trading 10% of your capital. So if you take, say, a 5 or a 6% loss, that's really only a 0.5 or a 0.6% loss because you're only trading 10% of your capital. It's nothing serious. And that's the whole point of protecting our capital right now, is we can still take these trades. We can still try to make money. So in this case, you have a 10% winner. Okay, that's really a 1% winner because you're only trading potentially 10% or less of your capital within these trades. So theoretically, you would only be allocating, if you had $1 million in your account, you'd only be trading $100,000 into these various trades. If you broke those into, say, 10 separate trading slots, 10,000 each, that would end up being 1% of your total trading capital, which means this would be a 0.1% winner right now. Nothing major, nothing substantial, but also understand that your losers would end up being much smaller. If you took a 10% loss, that would end up being 0.1% of your total capital. So you're really a 0.1% loser right now. You can still trade. We're just not being very aggressive to the downside or to the upside right now. Okay, let's come back over here and take a look at the S&P charts. We are still in this broad pattern that I showed you. I still believe we're going to likely move downward to this 3,400, which is why I suggest everyone really start to look for bottoms at or below 3,400 on the S&P. We are going to see weakness. We're going to see unraveling, I believe, because of earnings. We're going to see this move downward because of unexpected and revised earnings estimates going forward. Technology may do pretty well overall. Because I believe they're still going to be earning well. They're just not going to be earning at what everyone expects. Other industries could be really hurt. For example, as consumers are pulling away, we could see things change with regards to how consumers spend. I will tell you that certain consumer staples, you know, like Gillette and Heinz and other companies that are involved in providing food services, beverage services, beer, believe it or not, normally does very well during a downturn. People move to drinking. You know, it's just part of what happens. And so be aware that there's a lot of opportunity potentially still in beverage companies like Monster, Anheuser-Busch, Pepsi, Coke, things of this nature. They'll probably do quite well as we go forward, as well as consumer staples, for example, like Gillette and basic clothing companies, things of this nature. Dollar General, Party Store may come back around. So there's still quite a bit of opportunity, but this is really an unwinding of the excesses. So remember, what was excess during COVID was technology and disruptors and innovation, and a number of other sectors were still you know, very hot during the COVID and post-COVID area, real estate being one of them, autos being another, and that's something we could talk about. There's quite a bit of an issue going on in used car loans right now, lots of defaults setting up, could be a new wave of defaults going forward, but understand that that whole unwinding is taking place, whereas the stalwarts for consumers, grocery stores, Dollar General, discount stores, gasoline, Circle K, 7-Eleven, things like that, will all do quite well because consumers are still spending on essentials. They're still buying what they need to, but there's going to be a tightening of the belt generally, and there's going to be disruption for earnings going forward, which means we have, if we align, we have hypothetically a 9 to 10%, maybe 15% downside move yet in the S&P, and we will take a look over here at the NASDAQ. I have a lot of lines on the NASDAQ, but still, you can see I had originally highlighted this level. Okay, this was our original support level back off of these periods here. Came down and ran into this support level, still stalling, consolidating. If I could pull this out, I will show you that we are setting up a very broad flag. So roughly from this high across here, for this low roughly across here, let's just draw that as our flag formation, which means we now have a potential breakdown in Q2 earnings to the next support level, which is down here at 93, roughly 93.75. So understand that if we were to get a breakdown, we're flagging out, getting into earnings, we could see a little pop back down here into rotation, and then a breakdown down to this level. And this is where we want to try to find an opportunity for a bottom. And I will highlight this. If I can get my mouse to cooperate. I will highlight this as a potential bottom here, and this is where we're looking at, ladies and gentlemen, on the NASDAQ. So what this means is we have potentially, let me move this line, if I can, right here to here, about a 19% downside move in the NASDAQ before we ultimately find a bottom. And that's why I need you to be cautious right now. Earnings are coming out. It's going to be a very interesting day, very volatile over the next 3 to 5 weeks. We still have a lot of economic data. We have inflation data. We have housing data, jobs data. So be prepared. We're in the last wave, I believe, of a bottom. I don't think we're going to get there. Now, moderately, we could say that hypothetically, if we don't see this big downside move, then we're looking at a potential right in this area, still in this area. So I'm going to draw right around here. In this area to come back down to, say, 10,007, 10,005 in the NASDAQ, still finding support. It would be a new low. This could still be an intermediate bottom. So again, ultimately, I believe this is where we're going to want to try to go. But this middle level, this lower red level and downward channel, right, you can see this channel here. If we break down and come down to this level here, middle channel, roughly right along here, okay, we could see a bottom down in this area, 10,100 to 10,500. That could be an intermediate bottom, and that could qualify. This would be a complete channel. So now understand that we have this duplicate, and what's important to understand is to see this move from this area, a full 100% move means we have to come down to this 9,300 level in the NASDAQ. So understand that if this completes as a full 100% downside move, which I believe is very, very likely, then this is the ultimate low here. We might see a potential bottom in this 10,250 area, a temporary, let's call it not ultimate, but a temporary bottom, a little rebound. So hypothetically, coming from current levels, we could see it come down, bounce, and then come down even further. And that's something that we would need to be aware of. So don't be buying into anything until we have a confirmation of a bottom. Understand that cycle ends here in July 26th, 27th. So we're going to be looking at the end of a cycle period near the end of July. That could ultimately be our bottom right here. In fact, I will draw this so you can see it. And this could very well be our cycle bottom. It's important to understand that this is still 25 days away. Plus, I need you to be aware that this cycle bottom could be, oops, put that one back and get rid of these. could be our ultimate bottom in the markets. So understand that this cycle bottom right here could very well be our ultimate bottom in the markets, and this is what you need to be aware of. If you're trying to buy into this bottom, looking for opportunity, and you might get some pretty good bumps here on earnings, understand that we still have a long way to go, and if we break out of this flag formation, which I'll keep you updated, then we're looking at moving from this channel here, this orangish channel here, down to this lower channel down here, finding an ultimate bottom around 94, 9,500, and then beginning an upward rally. So this is not the time to get overly aggressive. Stay cautious and be aware of what's coming. Okay, let's take a look at gold and silver. So you can see here, I've highlighted this, what I call the double bottom. We had great recovery last Friday. And boy, this is the daily chart, so you can see this double bottom setup. We're outside of the pennant that I had drawn many weeks ago. I see this as a washout. In fact, I drew it a while ago. Washout low, a double bottom setup. I'm calling this capitulation. I feel we're going to move back into this channel here for another 5 or 6 or 7 days, and then really start to rally as fear takes over. We had a very strong close. If you take a look at this on a 10-minute basis, this was Friday, within that range, setting up that double bottom. You can see the selling pressure, the aggressive selling pressure. We got down here, a ton of buying came into the market, very strong rally, and look at this squeeze into the close. We could start out next week with a very big upside move on some volatility as earnings are starting to expect to come out for Q2. Remember, earnings are, in my opinion, going to be quite surprising for a lot of companies. Fuel costs have gotten excessive. Labor costs have gotten excessive. Everything has pretty much gotten excessive. So gold and silver are right now acting as a very solid base and bottom. And silver, believe it or not, below $20. Boy, I never thought I'd see this again. I thought we were clear above the 2050 area. So back here to the daily chart, and I'll tell you, I thought we were cleared above this level for quite some time. And now we've gotten down to this extreme deep low. And again, this really shows us how metals have come under pressure because of the dollar. Nobody believes, and this is really what's happening here, nobody believes that the metals are going to act as a safe haven, but you're watching Bitcoin and cryptos collapse. Exchanges shut down and go into default. You're going to watch metals start to come into very solid activity off of these lows. And remember, you come in to take a look at this on a weekly basis, and you can see this rally phase. It's very easy to see. We've had this rally through the 2004 and 5 area up to this high. Then we've had the devaluation phase. We formed the base right here. Then we had, and you can almost see the exact same thing here. We had this little rally here, and then a stalling formation clearing here. And then we had this little rally here, and then a stalling formation. Okay, then we had the COVID disruption right here, which sent the markets down to this reconfirm, this ultimate low. Now we've had this rally phase here, which is almost just like this right here, forming into another stalling sideways formation. Here's our big rally here, forming into a stalling sideways formation with a breakdown. Understand that breakdown is really right here, although in this case we've got extended lows. Let's call this right here, this low right here. And then what happened after this? This was 2008 and 9. This was the collapse of the market. So you see here, this was 2009, the collapse of the market, reestablishing roughly these lows. So here we have an extension from, let's call it these lows to these highs. You've got a greater than 61% retracement. And from this area, we have yet to even break the 61% retracement from these COVID lows. If this holds up at this level, then we're looking at a real opportunity to see this kind of a move right here back to the upside. And that, I believe, will send us in this mode even higher. So be prepared. I think we're kind of mirroring this soul sideways pattern. I believe this area here is very similar to right here, 2002. I think we've gone through this extended sideways flagging, which you can see here from 2004 to 2005. In this case, it was from 2016 to 2019, 3 years. So hypothetically, this took 3 times as long to get here. And then this whole reaction here took place, in this case, this was from 2006 to 2008, so that's 2 years. And from this case, we had from 2020 to 2022 was 2 years. If we see this other rally take place here, so this was a, from low to high, 470% roughly, duplicate, drag this from here to here, and this is silver, puts us at $60 or higher. Now that's only a 270% or 212% rally, so let's drag this up just for the heck of it, see what 470% actually looks like. There we go, $110 silver. Okay, that's what we're looking at for the metals markets right now, which is why when I showed you this, let me find it, come back here, right here. This is our setup. This is our early warning bottom setup. And remember, this was 2009. This was our bottom. We didn't reach the peak until back here, 2011. Okay, this is what we have here. We could see moderate consolidation and then a real skyrocketing. But it could very well be that metals are moving higher. If you look here, 2015, we had a nice rally. 2019, we had a nice rally. Let's take a look at this over here. So let me get rid of this. Hold on. Put this back up here. 2015, we had a nice rally. We sure did. Look at this. 2015, accumulation. 2019, we had a nice rally. We sure did. There's 2019, nice rally. Now we're starting another rally phase, and here we go. This is what could be the ultimate rally in metals, the real big deal that everyone has warned you about for many, many decades. So watch what happens when metals move into a real fear factor. Everybody's going to be piling to gold and silver. If you have an opportunity to buy gold and silver right now, physical or otherwise, please do it, and understand that you have a 12 to 24 plus month window to see this actually play out. It's an excellent safe haven investment overall. Better than bonds, better than buying stocks, better than buying any of the indexes right now. I believe metals are one of the greatest investments you can make right now, simply because you could see this 400 or 500% rally or more over the next 4 or 5 years, really setting up to 2026, 27, 28, maybe a bit longer as the markets really unwind this excess bubble. All right, that's it for now. Let's keep posted. And remember, we're looking for a bottom. No changes. We're not going to get aggressive. We're going to let the markets unwind through earnings. Follow me on Twitter. Follow me on YouTube. We're basically waiting for the markets to confirm a bottom right now. Metals should likely continue to try to move higher, but we're just waiting for the markets to start to confirm a bottom before we make any moves. All right, that's it.